Thanks for clicking. My name is Mark Mitchell. I'm a mortgage broker here in London, Ontario. The U.S. Federal Reserve and the Bank of Canada are set to make their interest rate decisions on Wednesday, with the market obsessing which bank will move first. With both countries experiencing the highest inflation rate in over 3 decades, with the United States at 7% and Canada at 4.8%, the two central banks will definitely be raising interest rates in the near future, but the question is who will be moving first.
Do it. You do it.
So what I want to do today is look at how the two central banks have traditionally, in the past 25 years, maintained a very similar monetary policy, with their interest rates moving in lockstep in one direction or another, up or down. I want to look at why that is.
We're in it together, huh?
And then I want to look at why the Bank of Canada will most likely be the first central bank to raise interest rates compared to the Federal Reserve. I had previously predicted that the Bank of Canada would not be raising interest rates this Wednesday, even with an increasingly large amount of experts and banks predicting that they would be, and with market data showing that there was a 71% chance that they would be raising rates on the 26th.
I stand by my decision.
With that said, we'll all be in the know come Wednesday the 26th, as both central banks are set to make their interest rate decisions, and we'll definitely have an update out soon thereafter. Click like and subscribe if you want to get those updates, but for now, let's get into how these two central banks have acted in the past. Historically, the Federal Reserve and the Bank of Canada have kept their interest rate policies moving in an almost identical direction. If we look at this chart over the past 25 years, we can see that except for a brief period between 2003 and 2004, the Bank of Canada and the Federal Reserve have followed one another in their policy rates. While there might have been some variance in the amount that those interest rates were raised or lowered, we can see for the past 25 years that the direction of those rate hikes or rate cuts remained almost identical, save for a brief period between 2003 and 2004, at a time when the U.S. was at war with Iraq, and obviously that comes with a whole other different issues that Canada didn't have at that time. But why is that? Why do we move so closely with the U.S. Federal Reserve? One of the main reasons is that the Bank of Canada doesn't want to see the Federal Reserve have an advantage. If the Federal Reserve raises rates and U.S. bond yields, the amount of money that can be made off the purchase of U.S. bonds rises, well then that'll put Canadian bonds at a competitive disadvantage. If you're going to make more money off buying U.S. bonds, then you're far more likely to buy those bonds rather than Canadian bonds. So when the US raises rates, we kind of have to.
I have no choice.
In contrast, when the Federal Reserve lowers rates, when it makes it easier to borrow in the US, the Bank of Canada doesn't want to see investors, those looking to set up businesses, those looking to grow the economy. The Bank of Canada doesn't want to see all of that capital move to the US and all the investment go to the US where the cost of borrowing is lower. So when the US lowers rates, the Bank of Canada also has to follow suit, so we can maintain our competitive advantage. So while cost of borrowing and competitive advantage are one of the main reasons that we do tend to follow the US Federal Reserve, it's also because we face many of the same problems due to us being so very interconnected. Canada and the US are both each other's largest trading partners, and as a result, we do face many of the same problems. If we look at this chart, we can see that the US and Canada's inflation rate also seem to move in very much the similar directions over the past 25 years. So when the US inflation rate goes up, Canada's inflation rate goes up because we're so interconnected. With so many goods crossing both borders, if wage demands go up in the US, the price of those goods are going to go up and Canada buys those goods, and vice versa. So because we're so interconnected, our inflation rates tend to move lockstep with each other, and as a result, so does our monetary policy. So because we're so interconnected and we face so many of the same problems, and neither country wants to see the other have a competitive advantage, both in cost of borrowing and in attracting new investment, we have followed a very similar monetary policy for the past 25 years, except for say 2003 and 2004. Speaking of similar problems though, Canada and the US are facing very, very similar problems this time around as well. As mentioned, we are both in, at minimum, 3-decade high inflation rates, with Canada at a 3-decade high and the US at a 4-decade high. And also, our housing markets are at record highs as well, with the United States seeing 16.9% price growth last year, its highest on record, and Canada seeing house prices up 26% in 2021, with both Canada and the US crushing previously held records for house price growth. So yet again, the Canada and the US are very much in the same boat. though I think Canada will be raising interest rates first.
I won.
Sure. So while both the Federal Reserve and the Bank of Canada will be tightening their monetary policies, the Bank of Canada has already done a lot of the early legwork, being the first in the G7 to roll back its quantitative easing program. If you remember, the quantitative easing program is where the central bank injects money into the economy by buying mortgage-backed securities and buying government-issued bonds. The Bank of Canada started to roll back its program back in April and ended it in October. So we've done a lot of the early legwork of ending our accommodative, our very loose monetary policy. We've stopped using our central bank, for the most part, to inject money into the economy. Contrast that with the US, which really just started its tapering program, its rolling back of its quantitative easing program in November. Well, the general consensus is that when you're trying to tighten your monetary policy, when you're trying to end central bank support for the economy, first you start with ending your quantitative easing program, and then you move on to higher interest rates. With the Fed not starting the end to its quantitative easing program until November, it has a ways to go until it can raise interest rates. While there has been talk of the Federal Reserve both ending its quantitative easing program and raising interest rates at the same time, that talk is scaring the heck out of the markets. So it's most likely that the Fed will end its QE program, quantitative easing, before it raises interest rates. But that doesn't mean that Canada is out of the woods. Not by any means. Canada maintains one of the largest debt burdens in the G7, except for France, even higher relative to GDP terms than the United States. So Canada, because of the amount of debt that it holds, because of the amount of money it injected into the economy, in relative terms to the US, in relative terms to the size of our economy, the Bank of Canada kind of had to start tightening its monetary policy first. So when you look at the US inflation rate at 7%, and you look at at Canada's inflation rate at 4.8%, it might seem as though the US is far more worse off than we are. But keep in mind that we haven't had a QE program since October. So we're still growing at this large inflation. We're growing at nearly 5% without a quantitative easing program in place. So I think there's a lot more pressure on the Bank of Canada to move faster than the Federal Reserve.
Just do it now!
Our inflation rate is growing, and the Bank of Canada isn't even injecting any more money into the economy, and we're only about 2 points, maybe a little bit over 2 points higher than the US's inflation rate without all of that support from the central bank. So clearly our inflation rate is continuing to go up and up and up. Like we said, it's at a 3-decade high. So while I still maintain my prediction that the Bank of Canada won't be raising interest rates on Wednesday, I've been wrong before, and if I had a crystal ball, there would be a beach in my background, not books, though I like the books. But I still maintain my prediction that they won't be raising rates on Wednesday, but I do think that the Bank of Canada will be raising rates before the Federal Reserve does. I don't think this is going to be a case where we see the Federal Reserve raise rates and then the Bank of Canada rushes in to raise rates as well. And I guess inherent in that prediction is that the Federal Reserve won't be raising rates on Wednesday either, as I think ending its QE program and raising interest rates all at the same time is going to just be too much that the economy can handle. Personally, I'm not confident that the economies of either Canada or the US can handle the interest rate hikes that are coming down the pipe in 2022. I don't think that they'll be able to handle that anyway, but I definitely don't think that they could handle them in rapid succession that some are calling for. So the good news is we will all be in the know come Wednesday as both central banks make their interest rate announcements, and of course we'll have updates on this channel immediately thereafter. So make sure you click like and subscribe if you want to get those updates, and thanks so much for watching.